This video is for anybody who is completely new to trading commodities. What I will be covering in this video is first I will go and have a look at Trading 212 and show you all of the different types of commodities that you can trade on that platform. When you are trading commodities on Trading 212, you are actually using CFDs. Technically, it's actually a CFD of a future, but we won't get too technical. A CFD, which stands for Contract for Difference, is essentially just betting on the price direction of the commodity. In this video, I will go through a practical example of trading a barrel of oil, just so you can see all of the different calculations on how an actual CFD works. So I'll show you exactly how you calculate your profits. Because when you trade with CFDs, you're often trading on margin, so I'll explain exactly what that is and how that all works and ties into the calculations also. So first off, I'm just going to take a quick look at all of the different types of commodities that you can trade with on Trading 212. So I've just come onto the list they have here on their website and I'm just going to go through it here. So for example, you can trade with cheese, you can trade with coca or coffee beans, you can even trade with copper or oil or cotton or loads of different types of commodities. So as I'm going through the list here, so you have gasoline, feeder cattle, gold, lumber, and natural gas, just to name but a few, but you have a huge choice there on Trading 212. And as I'm going through this list here, you will probably also notice here that they have a minimum quantity that you can trade for each type of commodity, and they also have your margin percentage. But first off, the minimum traded quantity, that is the lowest unit of that particular commodity that you can trade. So whether it be, say, a bushel of wheat or a barrel of oil. So they have their lowest kind of common unit size, and that is what they mean by that. Next up, one important thing to also mention is where you can actually access these on the Trading 212 site. So they have two different types of accounts on Trading 212. If you're outside of the UK, they have the investing account and the CFD account. And if you're in the UK, they also have the ISA accounts. But for anybody who is going to plan on investing in commodities, then you want to get access to the CFD account. And in order to get access to this account, you might have to do a small questionnaire just to prove that you understand what CFDs are before they actually let you go and trade them. So if you just tap the little icon in the top left hand corner of the screen, you will be able to switch between the different types of accounts. Now with all of that out of the way, let's go and have a look at a practical example. Before you open any position on any commodity, it is very important that you look up the commodity's margin percentage or leverage ratio, which are pretty much the same thing. So let's have a look at this first. So if you click on the instrument details on any of the commodities that you're interested in, then you will be able to scroll down and find this information. So as I can see here for Brent crude oil, the margin is 10%, or it's 1:10 leverage ratio. What this essentially means is if I want to bet on the price of Brent crude oil, I only need to put up actual 10% worth of the cash to open up a position on one whole barrel. So for example, the price of one barrel at the moment is about $72, but if I want to bet on the price of that barrel moving, then I only need to put up about 10%, which is about $720 to bet on the price of that moving. So that way you are getting exposure to a whole position with only having to put up 10% of the actual capital. So that is the benefit, but also the risky side of trading with CFDs, because you are actually investing with borrowed money. This margin of 10% will actually be locked up on Trading 212, so it will still be in your cash, but you can't use it until either you cash out your position or else you make such a loss that they have to close your position. And that's the reason that they lock a little portion of your cash, is because if the price goes in the opposite direction to what you have bet, they want to have a bit of cash there to cover your losses. So let's say I want to bet on the price of oil increasing, but it actually decides to fall. If it falls enough to cover the amount of margin that I put up at the start, then what will happen is I will get margin called. So when you are margin called, you have two options. You can either put in more funds to build up your margin again, or else you can just completely close your position. I will quickly just show you what this actually looks like now on the Trading 212 app. So I've just searched for Brent crude oil here. As you can see, there's lots of different types of Brent crude oil commodities here, and they all have different expiration dates. So that's all of the different types of futures that are on the market. So the reason that there are different expiration dates on all of these, it is because these are the actual futures contracts that our CFDs are actually trading on top of. So we are betting on the price changes of these futures contracts. So a futures contract, for example, is just a hedging tool. So what it is basically is, say if I was in a business where I needed to have a couple of barrels of oil in a few months' time and I was worried about the price changing, then I would go into a contract that locks in the price so I am sure of what the price I'm going to be paying is in a few months' time. So that's what these futures contracts were set up to do. But the CFDs that we are now trading are just betting on the price changes of those contracts. So the position I'm just going to open up is the Brent crude oil 30th of July 2021. If I want to bet on the price of Brent crude oil going up, I will hit the buy. I'll open up a long contract. And if I want to bet on the price of Brent crude oil going down, I will hit the sell contract. So this is the buy contract here. And so my position is opened. And then if I come back to my overall account here and I click on my account balance, you will see here that I have some blocked funds. I have some blocked funds there for oil, Brent and Lufthansa. You can ignore that. I was just messing around earlier on my phone. But so that is essentially my block funds, my margin that I put up. So the price of the Brent crude oil there was $73. So I put up a margin of about 10% of that, which is $7.2, and that's translated back into euros there. So it's probably about €6 something that I have locked there in cash that I can't use until I either close my position or else I lose it. Next up, I just want to briefly go through a profit calculation just so we completely understand how you calculate your profits and how the margin works with all of that. So let's say, for example, I wanted to open a position on barrels of oil again. So let's say the price of a barrel of oil at the moment was $72. And I wanted to bet on the price movement of 5 barrels of oil. So 5 barrels of oil at the price of $72 is the total value that I'm actually betting on is $360. Because the margin is only 10%, I only have to lock in 10% of my funds to actually open this position. And this 10% is equal to 10% of the $360, which is $36. So if the price of oil then decides to go to $77, that will mean my value of my contract is now gone up to $385, and I have made a profit of $25. So in percentage terms, that is really 69%, because you've only had to put up $36 to open a position and you're making a $25 profit. So that's kind of where the margin, you can make kind of high percentage profits quite easily, just because you're putting up a very low amount of capital at the start. But then if the price decided to drop to $65, for example, then the value of my contract would have fallen to $325, and that would be a loss of $35. And as you saw over here, I had a margin of $36. So at that point, I'm very close to being margin called. So if the price of oil dropped a little bit further there again, I would be margin called. I would either have to put in more cash just to restore my margin, or my position would be closed altogether and I would sign off with a loss then of $35, which would be a loss of really of 100%, because I would have only put in $36 and I would have also lost $36. So this is essentially why CFD investing is a lot riskier than normal investing in stocks. Like if you invest in a stock or something, for example, the most it's going to move is a few percentage points in a day. You might be up at most maybe 5 or 6%, or you might be down 5 or 6% on a bad day. But here you could easily be up 20, 30, 40, 50% or down the same within matter of a very short period of time. So that's why CFDs are a lot more risky. But also on trading 2 on 2, you have stop losses, which you can use to try and cut off any losses before they get any way too big. That's pretty much it for my explanation today. I hope this video was some way useful, and I hope you enjoyed it. And thanks very much for watching. If you did enjoy it, make sure to hit that like button and subscribe to my channel so you're kept up to date with my latest videos.